Today we're going to talk about purchases account. The purchases account is used to record the cost of merchandise that is bought for resale. Goods purchased for resale are one of the major costs of operating a merchandising business. Remember, costs decrease net income and therefore decreases the owner's equity. The purchase account is a debit. Cash is credited when we make a purchase. Here's an example of our journal entry. Notice that we have made purchases of $500, which is a debit, and we have cash credited $500, which reduces the amount in the cash account. The description in this example is purchase sports equipment from Schwinn with check number 86. Now we're going to learn how to prepare a schedule of cost of goods sold. The following steps should be used when preparing a schedule of costs of goods sold. Remember, we have beginning merchandise inventory, and to that we add the purchases of any new merchandise, and that equals the cost of merchandise available for sale. Then we subtract the ending merchandise inventory at the end of the accounting period, and that equals the cost of goods sold. There are several other items that affect the cost of goods sold. Sometimes we have purchases that are returned, and sometimes there are allowances or discounts. There are actual purchase discounts, and there is a cost associated with transportation on the purchases, getting them from the manufacturer to the store. Here's an example of a schedule of cost of goods sold for Warren & Sports. Notice the who, the what, and the when. Warren & Sports is the who, schedule of cost of goods sold is the what, and the when is for the month ended June 30th and whatever the year is. Please make sure you have for the month ended, not just simply the date. Notice also that we start with the merchandise inventory at the beginning. In this example, it's $18,000. Then we add the purchases that have been made during the accounting period, which is $42,400. Now, if some of these purchases have been returned or discounts have been given because we returned them, we put that here and make sure you put less purchases, returns, and allowances and put the money associated with that. In this example, it's $8,000. Then there are purchase discounts, which are outright discounts that the manufacturer gives to us. In this example, $400. We total those in the middle column and we get $8,400. We subtract the $8,400 from the $42,400 and we get a net purchase cost of $34,000. Now we have to add any costs for transportation, and we call this transportation in. That is, what is the cost to bring in our purchases to our business? In this example, the total is $2,000. So the total cost of merchandise purchased is $36,000. We add that amount to the merchandise that was in our inventory at the beginning of the accounting period, and we get the cost of merchandise available for sale, which is $54,000. We subtract the inventory at the end of the month. So we say less merchandise inventory for June 30th. That's $20,000 was left at the end. And we subtract the $20,000 from the $54,000 and we get the cost of goods sold at $34,000. Regarding purchase returns and allowances, these are goods that have been purchased and recorded in the purchases account, but then returned. Therefore, the cost of the purchases is decreased by whatever this amount happens to be. A new account, purchase returns and allowances, records these returns. Remember, we always have to keep track of all our purchases and any returns that we happen to have. This amount is subtracted from the purchases because we return this to the manufacturer. Purchases minus purchase returns and allowances. Now regarding purchase discounts. Sometimes we receive a discount for one reason or another, and when this cash discount off the invoice price is received, the cost of purchases decreases. A new account is made called the purchases discount. Account records these discounts. This amount is subtracted from purchases. So the math in this is you take the purchases and you subtract the purchases discount. The net purchase cost. These are the purchases minus the purchase returns and allowances minus the purchase discounts. Purchases minus purchase returns and allowances minus purchases discounts. We write less and less when we're writing these on the schedule of cost of goods sold. Transportation on purchases is sometimes called transportation in or freight in, meaning that this is the cost for transporting the purchases to bring them into the company. This must be added to the cost of the merchandise purchased. The transportation or purchase on purchases account or transportation in or freight in is used to keep track of all these additional costs. So now we have purchases, less purchase returns and allowances, less purchase discounts, plus or add transportation in. The merchandise inventory account contains the total dollar value of the goods on hand for resale or the merchandise. The schedule of the cost of goods sold includes the merchandise inventory account amount at the beginning of the accounting period and at the end of the accounting period. So during the accounting period, the inventory changes throughout the accounting period. At the beginning, we have a starting amount for the inventory, and as we purchase more inventory and as we sell merchandise, this goes either up or down. The balance of the merchandise inventory account appears in the current assets section of the balance sheet. The dollar value of the inventory can be calculated in one of two ways. One way is the perpetual inventory method, and the other method is the periodic inventory method. We're going to talk now about the perpetual inventory method. This method is used by retailers who must know the exact number of each retail item in the store. Records are kept for each item that is sold in the store, and these records are updated for each item that is purchased or sold on what we call a stock card. Generally, this method is used for retailers who sell a low number of high-priced items, such as vehicles or major appliances. It wouldn't be very practical to have this for some kind of a store that has thousands and thousands of items and thousands of different types of items. It's also used by retailers who use computerized or point of sale, also known as POS, terminals. These terminals use their computer abilities in order to keep track of these inventories on a minute-by-minute, second-by-second basis. The periodic inventory method is a different method used by retailers who do not think it's necessary to be continuously updated with their inventory. It's usually only counted once in a while, and the cost calculated at the end of the accounting period when financial statements are prepared. The counting of all the merchandise on hand is called a physical inventory. This total is recorded in the merchandise inventory account. Now we're going to talk about the chart of accounts for a merchandising business. Previously we have talked about chart of accounts for a service business, and there may be some differences for a merchandising business. There are several new accounts related to merchandising compared to service. These accounts must be listed in the chart of accounts. Some accounts are only for a merchandising business, not a service business. They're highlighted in the following chart, which is a copy from page 284 in the text. Notice we have assets, liabilities, owner's equity, revenue, cost of goods sold now is a new section, and we have expenses. So previously we had 5 different sections, now we have 6. Notice in the assets section we have a new one that's highlighted in a different color. In this example, it's given the account number 120, but it could be any number that you decide if you're the owner of the business. It's called merchandise inventory. In the liabilities section, there is PST payable, GST, HST payable, and GST and HST refundable. These are the new liability accounts. In the revenue accounts, we have sales, which we've already had before, but now we have sales returns and allowances and sales discounts. All of the items in the cost of goods sold are new, so we number these in the 500s now. So we have purchases, purchase returns and allowances, purchase discounts, transportation in, and cost of goods sold. Finally, in the expenses section, we have one new item, and that is delivery expense. Together we're going to read exercise 5 on page 308. We're going to complete part 5A. In this example, we have the University Colony Variety. This is a variety store, and it's their schedule of costs of goods sold. At the beginning of the month, we have an inventory of $5,000. Purchases have been added of $1,000. The cost of merchandise available for sale is $6,000. At the end of the accounting period on January 31st, we have an inventory of $4,000. That tells us the cost of goods sold for the month of January is $2,000. Now, complete part 5B. Part 5B, we have the schedule of costs of goods sold for the month of February. At the beginning of the month, we have $4,000 in inventory. We have purchases of $3,000 added to that inventory, which gives us a cost of merchandise available for sale of $7,000. We subtract the merchandise inventory at the end of the month, which is $3,500, which leaves us with a cost of goods sold of $3,500. Now complete part 5C, and we'll check your answers compared to the correct answers in a moment. For the month of March, we have another schedule of costs of goods sold. This time, we have the beginning inventory on March 1st of $3,500. We add purchases of $2,900. We subtract purchase returns and allowances. So for the first time, we've got purchase returns and allowances of $300. And we have a purchase discount of $100 for a total of $400 that we subtract from the purchases, which leaves us with net purchases of $2,500. We add transportation on purchases, it's the first time we've had to do that, of $190. The cost of merchandise purchased is $2,690. The cost of merchandise available for sale is $3,500 plus $2,690 gives us $6,190 available for sale. At the end of the month, we have the inventory calculated to be $3,100. We subtract that from the cost of merchandise available for sale. That leaves us with the cost of goods sold of $3,090. Now complete part 5D, and I'll pause and then we'll discuss the answer. For the month of April, we have another schedule of costs of goods sold. We start with inventory of $3,100 at the beginning of April. We add purchases of $5,600. We subtract purchase returns and allowances of $600 and purchase discounts of $150, and together they total $750. We subtract that from the purchases and it gives us $4,850. We add the transportation of $320. That gives us the cost of merchandise purchased, $5,170. We add that to the inventory at the beginning of the month, and that gives us the cost of merchandise available for sale for April to be $8,270. We subtract the inventory at the end of April, that's $4,700, which leaves us with $3,570. Your assignment is to complete questions 3 to 8 online and complete exercises 4 and 6 now that we've done exercise 5.